Thanks, everyone. Ladies and gentlemen, welcome back. It gives me great pleasure to introduce our final speaker for the day, Meb Faber. Meb is an author, an investor, and a thought leader. And I'll just do a quick intro. So Mr. Faber is co-founder and chief investment officer of Cambria Investment Management and the manager of Cambria's ETFs. I believe you're around about a dozen of them at this point, Meb. Meb's also the host of the Meb Faber Show podcast, which is terrific, by the way. You're coming up on 200 episodes, so big congrats there. You do a great job with that. Meb's authored numerous books, which you see here today in the library. He's a frequent speaker, a writer. He's active on Twitter. You've got about 65,000 followers or so congratulations.
A lot of bots.
Yeah, a lot of bots. Very good. You've been featured in Barron's, the New York Times, the New Yorker. You graduated from the University of Virginia with a double major in engineering and biology. Ladies and gentlemen, please give a warm welcome to Mr. Meb Faber. So we really appreciate you being here. We chatted a little earlier about the weather, and Meb's from Los Angeles area, so I think kind of mid-70s, a fair bit of sun there this week. So you've gone half in the temperature and not a lot of sun.
I heard it's the coldest day. This is my first time in Toronto. Coldest November 13th on record. I showed up in tennis shoes and a t-shirt. Poor decision.
Well, it didn't just surprise you, it surprised all of us here as well. So in addition to being a thoughtful investor, Meb's also a skier and a surfer. Surfing here is not so good. Skiing's pretty good, and I guess the upside of this weather is that it looks like there'll be some skiing here this weekend. Now I think Mammoth opened last weekend. Any chance you caught opening day?
No, but I'll be in Lake Louise this weekend, Saturday, if anybody else is there. Hopefully be able to get a day in.
Beautiful.
Never been there either. Excited.
Well, I wish you a good season.
Thank you.
Okay, so let's get into it. We'll start with, thought we'd start with, you're a self-proclaimed quant. You're a quant investor. For those of you in the room that may not really know what that means, I think it's a term we've probably heard it a few times today. I thought maybe you could start with, what is a quant? Why do you think that approach to investing works for you? Why does it resonate with you? Just maybe help us with a bit of a definition there.
Yeah, sure. First, thanks for joining, guys. The last episode of the day before happy hour. If anybody wants to go out, get a beer, come back in. That's okay with me. I won't be upset. Just grab me a pale ale. To me, I'm an engineer, and so I always smile at this question because I scratch my head and I think, what's the alternative? And a quant to me means nothing more than just having rules. And the odd thing is we talk to a lot of investors. So we have over 40,000 investors. We talk to everyone from retail, grandma in Texas, to RIAs, financial advisors, to some of the biggest endowments, foundation, pension funds in the world. And it's surprising how few actually have a written investing plan. And I'm not going to ask you guys to raise your hands because it's embarrassing, but normally if you say, do I actually have a written investing plan, hopefully one that you've shared with your spouse or children or clients or neighbors, whatever it may be, very few people do. And the problem with that is the same as if you don't have a plan for dieting, for exercise, whatever it may be, it allows the behavior and emotions to creep in. So quant doesn't have to be complicated. It could be, I'm going to do a 60-40 portfolio, rebalance once a year. That's a rules-based portfolio. And for those of you who don't know, 60-40 means 60% in stocks, 40% in bonds. It's not the Canadian version, which is 60% in junior minors, 40% in cannabis, which is having a tough day. That's a very basic rules-based portfolio that, by the way, has beaten most institutions over the past decade. We're kind of what I consider to be quant light, which just means everything we do is rules-based. There are specific rules for how to manage these portfolios, all the way up to what a lot of people I think of when they think of quant, which is high frequency, crazy algorithmic, what Greg's talking about in the next room. His book is great, by the way, on Simons and Rentec. We're somewhere in the middle. And so everything we do is based on these ideas. And I think it's so important where as you think about putting together a portfolio and putting together, if you're adding a new position or taking out a position, it's almost the end of the year. It's almost the end of the decade. I know most of us are not ready for that fact, but we only have, less than 45 days left in the decade probably. And that means it's always a good time to reflect. As you sit there on December 31st, having a glass of champagne, a beer, whatever it may be, toasting with your loved ones, it's always a good time to look back and say, here's my portfolio. But also to say, let's hide that for a minute and say, here's what my ideal portfolio should be. And if the two of those don't match up, there's a problem, right? The same way that we become enamored with the things we hold elsewhere. If you go out to your garage or into your closet, that's a pretty good example. People have a different emotional attachment to things they own that they don't own. The same thing happens with the portfolio. I guarantee you, if you were to say, blank slate, here's what I'm going to allocate my portfolio, if it's not the same thing as what you currently have, there's issues. In the same way that if your house burned down, I guarantee you no one here would wake up tomorrow and say, you know what, I'm going to buy the exact same clothes I had in my closet. No one would do that. If you look at what's in your, okay, it makes it easier to frame it, your parents' or your neighbor's garage, and say, if that burned down, you go buy that same crappy lawnmower, that fish tank that's been there for 20 years. Same way to think about a portfolio. My whole point is that it's really important to have rules when it comes to an allocation, and most of us really just want to wing it. And even the people that do have rules, if you haven't constructed the rules in a way that looks back at history or is really honest with yourself, that's problems too. Look at a lot of the endowments in the last financial crisis. They have policy portfolios, they have whole committees, they have everyone involved in building a rules-based set, and then guess what? When it hit the fan, it turns out they didn't. So we spend a lot of time thinking about that. All of our funds are quantitative and rules-based, but also it's important, I think, in how it all fits together. Because if you don't, I think that's where a lot of the bad behavior happens, and we could talk about the bad behavior all day long, because that's where it really, the actual investing side I think is pretty easy. It's the human side that's hard. So just building on that, so about how it all fits together, you've done a ton of thinking about how to allocate portfolios to the various asset classes, to the various factors, whether we're talking about momentum, trend, value, what have you. So in all of that thinking and all of that experience, as a portfolio manager, and this is a totally unfair question, if you had one lever to pull, what lever would that be that you think would have the most impact on portfolio management? And maybe, sorry, if you could also maybe just help us. I think the difference between trend and momentum. Sure. Maybe just help us with that. This is going to be a long answer. So I think it's important to establish what I consider to be a base case framework first, and then I'll answer the question. I'm pretty opinionated on some topics, extremely opinionated, and some I have no real strongly held conviction or am agnostic. I actually believe, and I'm probably the only person that I know that believes this, that your broad strategic asset allocation really doesn't matter. So we did a book called Global Asset Allocation. It's free online. If you go to our website, Cambria Investments, you can download it for free. Where we looked at, there's a lot of gurus out there, famous people, that manage in the trillions of dollars. So everyone from Warren Buffett to David Swinson at the Yale Endowment to Mohammed El-Arian from PIMCO, Harvard, on and on and on. These people at one point have publicly stated, here's our recommended asset allocation for individuals or institutions. And we said, okay, well, why don't we take these 20-odd recommended portfolios that are vastly different, hugely different portfolios. Some said you should put 90% in stocks. Some said 25%. Some said you should have 25% in gold. You guys love that. Some said 0. Some people said you should have a bunch in 55% in bonds. Some said 0 or 10%. Totally different asset allocations. And that's what everyone spends all of their time thinking about, right? Gosh, is interest rates going up? Should I have some gold? What's the Fed doing? Are U.S. stocks expensive? Are there opportunities elsewhere? Because that's a sexy, fun stuff to talk about. So anyway, we did this horse race. Being a quant, I said, let's look back to 1970s. We eventually took it back to the 20s and said, what can we tease out of this data? Who won and why does it matter? And so it turns out they all did a great job. They all made money over time, but they took different paths to get there, not surprising. The 70s, for those who were there, were terrible for everything on an after-inflation basis for the most part. But the interesting takeaway was that all of the portfolios, if you were to take that whole 50-year period, if you look back at the end of the day, the compounded return was within 2 percentage points of each other. And if you exclude the worst, which was the permanent portfolio, which was also the most stable, and it's not really fair because it has about half in bonds and cash, all the rest of the portfolios were within about 1% of each other. Here's the fun takeaway. So you go back to 1972. If you guys have seen Back to the Future, I'll give you the DeLorean. You go back to 1972, I give you Biff's Sports Almanac, but for financial markets. I say, here's the deal. I'm going to let you pick the single best performing asset allocation to 2019. Okay? Got it? How much would you pay for that? A lot. How much would RBC, all the Canadian banks pay for that? In the billions, right? You have perfect foresight. Which one of those asset allocations is the best? But I said, however, Doc, I have one caveat. You have to implement this portfolio. I'll be fair. I'm going to say the average mutual fund fee of today, 1.25%. That takes the best performing asset allocation in the book, which is Mohamed El-Arian's, the endowment portfolio, very heavy in equities and growth sort of investments. It takes the performance of the best performing portfolio and makes it almost as bad as the worst. So let that sink in for a minute. Just by implementing this portfolio with the average mutual fund fee of today, not the average fee of 10, 20, 30 years ago, of today, you make the entire asset allocation decision of what you put in what almost totally meaningless. And then you say, no, Meb, I don't trust myself. I'm a terrible investor. 2009, I was selling stocks. 1999, all I wanted was AOL and CMGI. So I need a financial advisor. And the caveat is, I love financial advisors. I think they're worth their weight in gold if they're doing all the value-added stuff traditionally that's not investment management. So I'm going to offend the whole room at some point by the end, but let me just say that I love financial advisors. But let's say you add on the average financial advisor fee of today, 1%, again, not E.F. Hutton, Smith Barney days, of today to implement that portfolio with the average mutual fund. That takes the performance of the best asset allocation and makes it far worse than the worst. So this is a view that where I'm starting from the base case is I actually don't think your asset allocation matters if you're doing strategic buy and hold asset allocation. That means global stocks, global bonds, global real assets. And we get pretty granular in the book, tips, emerging markets, real estate, all that good stuff. It's kind of like baking. My mom's a Southern cook. You know, she would just do it by hand, by memory, how much salt, stick a finger in the sugars, a little more, mix it all together, and it always came out great. Chocolate chip cookies were incredible, but I say the only way it doesn't come out great is you forget one entire category of ingredients. You forget flour, you forget chocolate chips, you forget the eggs, you're now a keto guy, whatever. Only then does it end up being suboptimal. So we say, as a starting point, the global market portfolio. So if you just go out and buy the entire world of public assets, that's roughly half stocks and half bonds. And of that, it's roughly half US and half ex-US, okay? That's a pretty hard portfolio to beat, first of all. We often joke that our favorite portfolio from the book was the Talmud, which is 2,000 years old. That says you should invest a third in business, a third keep in reserve, and a third in land. So we said real assets, bonds, stocks. That's also nearly impossible to beat. As long as you have that base case set, and that's kind of like the asset allocation for dummies, right? You should pay nothing for that, zero. And you currently can pay nothing for that. I call nothing 5 basis points in the US. You buy a basket of ETFs, costs 5 basis points for that portfolio. If you include the fact that most ETFs actually do short lending, that portfolio actually has a negative expense ratio, very likely. So you're actually getting paid to own that portfolio, okay? So once you have that base case set, whatever it may be, the global market portfolio, do I think you can improve upon that? Yes, I do, okay? But that is the bar from which you need to reach. And that's the beginning starting point from which you say, okay, I'm willing to pay more now. So now let's go back. What are the biggest additions you can make to that portfolio to improve the returns, reduce the volatility, and drawdowns? There's two broad pillars that we believe in, neither of which we've invented. They've been around for 100 years, since the time of Charles Dow, when he started the journal, and since the time of Ben Graham writing about security analysis, and honestly, probably hundreds of years before that, but really in the modern financial markets. And that's value and momentum and trend. We'll start with value because that's really simple. Everyone here knows what it is. It's hopefully paying less for something than the market thinks it's worth. And there's obviously quantitative ways to do that. And we often say, and we'll come back to, I think, value in a little bit, one of the biggest benefits of value that I think a lot of people get wrong is it's not just about buying the cheap stuff. It's also about avoiding the expensive stuff and doing the really dumb things. And so both of those parts really matter. And traditional market cap weighted indexes, it always surprises people, there's no tether to value whatsoever. Which, if you think about it, is a really odd way to go about investing. And I'm referring to basic passive indexes like the S&P 500. You say, we're going to buy a bunch of companies, and you know what? We're not going to pay attention to the value whatsoever. Does that make sense to anyone? That's always a really strange, odd idea to me. So tilting towards value, we think, makes a lot of sense. And then on the flip side is a concept of momentum and trend. And so for those who aren't familiar, momentum is an idea. If you think about cars going around a racetrack, and one car is accelerating and doing better than others, that's momentum. And you kind of compare them against each other. So a good example right now would be US stocks have much better momentum than most commodities, for example. And then there's trend, which is nothing more complicated than, is an asset going up or is it going down? There's a million ways to measure that. It's a very simple one, something like a long-term moving average. And the big thing about trend is it keeps you out from the deep, long drawdowns. And historically, both work great and for different reasons. And so when we put together a portfolio, we do tilts towards value. We do tilts towards momentum and trend. And trend, but both these, the problem is, you have to look different. And that's really, really hard for a lot of investors. So if you have any of those buy and hold asset allocation portfolios, the biggest problem from those is 2008, 2009, okay? You're sitting on your hands and you just repeat the mantra day in, day out, buy and hold, relax, rebalance as your portfolio goes down 10, 20, 30, 40, 50, which is what a lot of people experience. That's hard for a lot of people to stick with because in the Great Depression, your portfolio, and if you were in equities, went down 90 in the US. So trend did wonderful in 2008, 2009, for example, but it's also hard to stick with because it often does poorly when markets are going sideways or when your neighbor's doing great and the S&P is romping and stomping for 10 years because you look different. You say, my gosh, why am I allocating this strategy? I should just all be in the S&P 500. So there's sort of a nice yin-yang where the two fit together. I think we allocate more to trend than any advisor that I've ever met. So our default allocation is half. We do half in buy and hold and half in trend. And because it's kind of a nice yin-yang sort of portfolio that I'm going to quote Bogle, where he used to say he put half in stocks and half in bonds because he'd spend half his time worrying he had too much in stocks and half the time worrying he had too much in bonds. I'm sort of the same way with trend and buy and hold because if you think back to the end of 2018 when things looked like they were starting to implode, he said, man, I'm really glad I have something in trend. And then sure enough, 2019, say, man, I'm sure I have half, 1 foot in the fundamental buy and hold ground because things bounce right back up the races. That's the really long-winded answer to your question. So those are my two foundations, but with the foreknowledge that you have the base set and running and that foundation as well. And by the way, this is casual, so if anyone's got a question or we're going over something you don't understand, just raise your hand, yell out.
Beautiful, thank you. Maybe just, so the title of this presentation is the best investment opportunity in 40 years. So that may have drawn a few of you here. So Meb, what's the best investment opportunity in 40 years?
So we spend a lot of time talking to investors. We run all these public funds, and sometimes at happy hour, someone will come up to me and say, hey, Meb, I bought your ETF, and we have a dozen of these, about 3 months ago, and it's not doing so hot. And I said, you haven't seen anything yet. It could do far worse than that. And they kind of nervously laugh, and I'm like, oh, no, I'm serious. It could do much, much worse. There's an institutional poll I saw at one point that asked a bunch of institutions how long they would accept an allocation to a fund manager underperforming and before replacing that manager, and 99% said 3 years or less. Every single one of those allocators should be fired. We used to say, when someone would ask me, hey Meb, I'm allocating this asset class or strategy, how long should I give it before I know confidence that it's working? And I used to say 10 years, and people would laugh, and now I say 20. Let me give you a relevant example, and this will lead into the idea. Everyone knows Warren Buffett, amazing investor. You go back to 1999 and you say, I'm going to just buy the stocks that Buffett buys. And every quarter I'm going to rebalance them when they're public. It's literally the easiest strategy on the planet. Buy the top 10. It takes 5 minutes a year. It turns out you take that from 2000 to 2019, you would have beaten the market by about, I haven't updated it recently, but let's call it 4% a year. That trounces 99% of mutual funds, equity mutual funds. And you don't have to pay them anything, right? Amazing strategy. Here's why no one would ever have done that, because 8 of the last 10 years, he's underperformed the S&P 500. So imagine you allocate to a manager, underperforms the first year, that was stupid. Why did my neighbor tell me to invest with that guy? What does he know? 2 years in a row, he's probably gone. Right? Career risk at endowments, foundations, pension funds, no chance of that dude sticking around 3 years of underperformance. What about 8 out of 10? So Buffett, as we often say, his strategy is not that complex. AQR wrote a paper, turned it into algorithm. Like, it's not that hard what he does, but his alphas, he sticks to his knitting. In 99, when he was underperforming the NASDAQ by 150 percentage points, not basis points, 150 percentage points, and every single magazine in the world was saying he's old, he's a fuddy-duddy, he's lost his touch. And then he went on to crush it for the next 10 years, is that he sticks to his knitting. And the seduction is to chase strategies. I gave a good example on Twitter the other day. I said Morningstar named the top 5 candidates for mutual fund manager of the decade in 2010. And I said, guess how many have outperformed since? 0, right? But that was not to just dunk on Morningstar and say you guys are idiots. It was to actually say these guys, these strategies can go a really long time and still be valid. So often these regimes that go on with asset classes and markets and strategies can last a really long time. Let's take the most basic. Everyone here knows stocks outperform bonds. But they have gone through periods in the past where stocks underperform bonds by 10, 20, 30, and then if you go back long enough, 40, 50, 60 years. That's an investing lifetime. Most of us will not be here in 60 years. All the younger millennials in here, you got a good chance living to 120, so you got a good shot. But to have an investing belief that you fully believe in that may not work out in your lifetime is a really hard thing to go out. But almost everyone here probably believes stocks outperform bonds. So you have these really long periods that don't coincide with how people behave. So the one right now, again, we're sipping champagne at the end of the year. Everyone's celebrating that returns. If hopefully you guys, this is a little harder in Canada. Say you're in the U.S. Usually I can say this because that thing has been romping and stomping for a decade. You're patting yourself on the back for having a huge allocation to the world's biggest market. And we say Jan 1, wake up, get over your hangover, take your medicine, because the next decade's probably not look like the last. And so we follow 10-year price-earnings ratios for every stock market in the world, foreign, developed, and emerging. That's about 45. We use what we call the Shiller price-earnings ratio, which is a 10-year version to get a really long-term perspective. And he actually based his work on Ben Graham's work, who came up with the idea of saying we're going to use a 5 to 7 year average on price earnings, so we'll get a estimate of a fundamental value for this stock or security. And Shiller said, let's do it for the whole stock market. Turns out the average over time is around 16, 17. It can be a little higher in low inflation environments, so let's call it 21. But in the US, it's been as low as 5, and it's been as high as 45 in 1999. Okay, true bubble territory. That was the bubble. That was my bubble. I was in college at the time. It was an awesome bubble. I was just back in my alma mater on Friday, and I was joking, but I was being totally serious. We had classes where professors were checking stocks during class because they were going up so much. So there's a wide range of valuation spectrum. So we went and built these for all the countries in the world. And I think we were the first to do this. Now a lot of places you can find this. I have a pinned tweet that lists a bunch of resources if you want to look where they are. If you look back at the history of markets, you see markets love going through these bubbles and booms and busts. And where you look at right now, there's good and there's bad news. The bad news is the largest economy and market in the world is also one of the most expensive. So the US trades at this long-term PE of around 30. Again, that's not a bubble to me. It just means it's slightly expensive. That doesn't get you invited back on CNBC to talk about it, say, well, chances are this is going to have low single-digit returns, which, by the way, before Bogle passed, that was his estimate for what US stocks would do for the next decade. But it's not negative and it's not terrible. So that's the bad news. The good news is most of the rest of the world is reasonable to cheap to downright really cheap. And so if you look at valuation metrics for the past 50 years, and we can take this back even further with some markets, they zig and they zag. It's funny, as I talk to friends in the US about this, they say, no, Meb, you don't understand. The US is allowed to be more expensive. We have rule of law. We have a stable government, which I always laugh at. You know, the companies there's better accounting, all these excuses of why we're allowed to have higher valuation. So I say, okay, as a stats person, if that were to be true, then the US should have had a higher premium over time. And so what do you think that premium should be? And I ask people, and I say, well, the correct answer is actually 0. Historical premium is 0. And so if you look back 70 years, as an example, US versus the rest of the world, US has beat the rest of the world by 1% per year. And that doesn't sound like much, but if you compound at 70 years at 1% per year better, it's a huge difference. Guess how much of that has come since 2009? All of it. Okay, so this decade, if you're looking back and making decisions based on the last 10 years, it's probably not going to look like what the last 10 years have looked like because markets go in and out of fashion. So you have this headwind of valuations. The good news is most of the rest of the world is reasonable to really cheap. Here's the problem. When you're investing in the cheap stuff, it is almost universally really friggin' hard to buy those countries. Why? Because they're already down 40, 60, 80, 90%. They have terrible, terrible geopolitical news. Their economies, some of them have been essentially going through their own Great Depressions. Some of them are invading other countries. It's just the nastiest, awful of the worst, right? But if you buy that, this is actually our largest fund does this, you buy the 12 cheapest countries in the world, that gets you a PE ratio about 11. And emerging markets, depending on the index you use, are somewhere between 11 and 15. Foreign developed is up around 20, US is 30. So looking at whichever region you choose, you get somewhere between a 50 and 66% discount on valuation. But the problem is, if you guys run out of here, it's too late today. Tomorrow, call your broker, which by the way should be 0 commissions at this point. If you're paying more, it's voluntary. You like your broker so much, he needs a nicer car, better chalet and Whistler. But the default is now 0 commissions. Call them and say, broker, I got a great idea. I heard this wonderful speaker, he's handsome, brilliant, and he says we need to buy Russian stocks, Greek stocks. No, hold on, no. Just wait a second, just don't hang up. I'm not done yet. Turkish stocks, on. And he's gonna say, you're an idiot. What are you thinking? If an institution, you say, my God, this is massive career risk. We buy these, they do well, we get a pat on the back, as we're supposed to do. We buy them, they do poorly, you're fired. Forget 2 years in a row, no chance. But that's what it takes to outperform over time with value, and it's not always those countries. If you go back to the late 90s, totally different set of countries. You go back to the early 80s, US, right? No one wanted the U.S. because in the early 80s, so the valuation spread we're seeing between the U.S. and the rest of the world, and particularly the cheap stuff, is the biggest spread we've seen since the 80s. But guess what? In the 80s, it was the opposite. The U.S. was the cheap one. And if you guys remember, the market historians out there, the ones who lived through it, Japan was taking over the world. They hit, and by the way, the largest market cap stock market in the world at the time. U.S. is the largest now, a little over half. Japan was the largest at the time. Japan in 1989 hit a long-term P/E ratio of almost 100. This is the biggest bubble we've ever seen. It's not even close. And then everyone talks about the 2 lost decades and demographics and why Japan's not been competitive. Well, the stock market just got to be the biggest bubble we've ever seen. It took 20 years to work off. But the U.S. was cheap at that point. But every magazine article was about the new Japanese business model. They were buying golf courses in California. They were buying skyscrapers in New York. But the problem is this plays out over long time horizons. So the thing that we say, if you were to have to buy one of the major market allocations, it would be emerging markets, which in the U.S. at least, the stats I have, the percent of your total allocation should be about 15%, and most people allocate 5%. So already way under allocated, despite the fact it's the most people in the world, the most production. Every single statistic is in the favor, highest growth, highest real interest rates, on, and the cheapest valuations. If you're really weird like me, you would go into the cheapest countries of the cheap and allocate there. But it's an opportunity, I think, over the next decade, it will play out. But when you guys have me back here in 2029, we'll see if it played out.
So related to this opportunity, and you've hinted at it a few times, let's talk about investor behavior for a second. So there's investment theory and there's valuation opportunity and all that stuff. And then there's the investor that's got to, stick to it type of thing. So, Meb, in your experience, what things have you seen people do, or how have you helped people kind of hang on, do the right thing? And I'm not talking about just the novices. I mean, the novices through to the pros get thrown around by these behavioral biases. So, what types of things have you seen people do to manage this stuff?
I love the behavioral research that Thaler does, where it's essentially nudges to help you not light yourself on fire. So, you want to lose weight? Hey, Einstein, don't put pizza in the refrigerator, right? Don't put a cake in the refrigerator, otherwise you're going to eat it. With investing is, one, talking about having a written plan, sharing it with someone so you're accountable. So when you talk to your spouse and you're like, hey, I really think cannabis stocks bottomed, they say, is that in our plan? Like, what are you talking about? But also, I love the new automated services, what people call robo-advisors, digital advisors. I love something as simple as a target date fund. Okay, because people frame them differently than they do their brokerage account. Brokerage account, they think about investing, trading, right? If you think about your retirement account, target date fund, that is so frigging boring, you don't even think about gambling with it. So trying to frame things as savings versus investing, I think is a big one. And then also realizing that your main base case buy and hold allocation is going to get you 4 to 5% over time after inflation, and just be happy with that. And then what else? It's easy to talk about the emotions. It's a lot harder to do it. I think having the fundamental anchor that we just talked about, valuations, at least gives you perspective and say, okay, well, we're following our plan or not. And then when it gets to when the world's losing their mind. So my favorite sentiment study is the AAI, American Association of Individual Investors. Go back to the 80s, and they asked people, are you bullish, you neutral, or bearish on stocks? And the single highest bullish reading ever was December 1999. You literally could not make that up, in the exact opposite direction. And guess when they were most bearish? March 2009. So following some of these things and taking a step back from the crowd and saying, has everyone else lost their mind, or am I just the crazy one, I think is useful. And having it automated in some way, shape, or fashion. I'm probably the only person in the room that puts all my public assets, almost all of them, into just one fund. And that takes away all the decision for me. It goes into one fund and that's it. There's a lot of different hacks, but the worst anti-hack is just winging it. Because then there's really no pathway to success. It's more just waking up on Friday and seeing how you feel.
Very good. Sort of related, what's the best piece of advice that you've received, best piece of investment advice, and what book do you find you're recommending most to investors to help them out?
We'll work backwards. So my favorite book, it's expensive, so get it in the library, is Triumph of the Optimists. And it's by a couple of British professors, 3 British professors, and it looks at the history of markets back to 1900. And it's a coffee table book, and it's written at a fairly high level. By the way, you can get free yearly updates. Credit Suisse does them every year for like the last 10 years, called the Global Investment Returns Yearbook. You Google that, you'll find it. There's about 10 of them. So if you're cheap like me, you don't want to spend the money, just get one of those. But the interesting thing is, one of the biggest struggles as investors is not knowing history. And the same thing with any relationship. There's polls every year that go around. They ask investors, what do they expect for returns? And recently it's 10.2%. Okay. Historically, one of the best performing stock markets in the world, US market, hasn't even returned 10%. So how you possibly get to that number is beyond me. In a world of low interest rate, we didn't even get to interest rates. In a world of 2% sub interest rates, how do you possibly get to 10% annual returns? Millennials is 11.7 or something, because they've never been through a bear market. So having this perspective of history, you can go back and say, look, I understand stock markets regularly go down 50, sometimes even, worst case scenario, 80, 90%. That's recently happened in a fair amount of countries around the world, by the way. I understand that entire markets have shut down. You're an investor in China, Russia, thank you very much, they went to zero. I understand that bond markets, because of hyperinflation, can lose all their money. And I understand that almost any asset allocation you can possibly come up with will lose at least 25% at one point. And if you don't know that, then you haven't studied history. And so as if anyone that has expectations in relationships, with jobs, the worst psychological damage that can happen is expectations are not met. So you think you're going to get 10, 11%, and you get 2, that's a problem for your retirement, for everything else. If you have more sober expectations, and 2008 happens again, you say, oh, this is no big deal. I've seen this playbook. That's why it surprised so many people in 2008, 2009, because the people managing money in 2008 and 2009 didn't manage money in the Great Depression. So they had no base case scenario to compare it to unless you studied history. So my biggest piece of advice is to go back, study history. It doesn't necessarily going to rhyme, obviously, but there's some helpful parallels. We do a lot of tweets where we say something I disagree with, something I believe that at least 75% of my professional peers disagree with. And one more example was almost everyone assumes, let's say you won the game, you're rich, congratulations, everyone here, got 50 million bucks. I say, what's the safest investment? Almost everyone will say government bonds. In our case, it's T-bills. And that's actually not true historically. I did a tweet and I asked people, how much, if you put your money in government bonds, after inflation, what was your biggest drawdown, your biggest loss at some point? And I think like 80% of the people got it wrong, underestimated 5% or something. It's half. At one point, because of inflation, you lost half. And so actually, to preserve your wealth, one of the best possible ways is you actually have to invest at least a third of that money in your safe account. This is not in your investing account, in your just to keep up account. So anyway, but all these ideas and concepts come out of a study of history, at least understanding the potentials of what's possible. And then, of course, realizing the future may be a little different. As advisors, we love telling clients, it's okay, we've seen this before. When eventually something comes along, we haven't. A world of mostly negative yielding sovereigns, that's a little weird. That wasn't in my finance textbook. Maybe it was in y'all's, but that's my favorite book. You can try to get it online, though.
Beautiful. There's a bunch of stuff we could talk about. We're just about at time. I wonder if anyone in the audience, if there are any questions for Meb? Otherwise, we'll keep on going.
Yeah, come on, guys. It's almost happy hour time.
Yes.
Yeah. The best ideas is, so one of the worst thing, I'm assuming you're mostly Canadians here, you're friendly, so I'm apologizing. The dumbest mistake we consistently see people make, and don't feel bad because this applies to everyone in the world, is they put way too much money in their own market. And everyone does it. In the US, U.S. as a percentage of the world is half. Average American puts in 80% in the U.S. And we say, you guys, that's fine. At least you should know that. But it's a massive, what we call home country bias. And everyone around the world has I understand the companies here. I'm more comfortable with American companies. Well, guess what? Canadians do it. It's way worse for you guys because your percentage of world market cap is single digits. So this massive, 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 massive over-allocation to your own market is a horrible idea. Japanese do it. Our friends in Latin America put 90+%. Hey, guess what? That's not looking too good this year if you're in Argentine. Anyway, so looking at the global portfolio, the best opportunity is moving to emerging markets, and in particular, the cheapest markets around the world. Canada, average price. Most countries spend most of the time being average, sort of normal price. And any valuation metric you use, you cannot come up with one that says the US market's cheap. So valuation is a very blunt tool that plays out over many years, not months and quarters. On the same side, you cannot come up with a valuation indicator that says some of these other countries like Russia, Greece, et cetera, are expensive. So at least getting to the market weight, which is half US, which we say to move further away from that, and then essentially what would that be? 38% foreign developed, 12% emerging, which most people don't already have. And then tilting more towards value if you're weird and uncomfortable. We recently had GMO on our podcast, a big money manager, and they have a benchmark free fund. And I said, they're big on emerging markets as well. And I said, Ben Inker, I said, Ben, how much do you guys have in US stocks? And he said, 0. And I said, well, you don't mind being pleasantly weird and different. So to me, it's the cheapest countries in the world and tilting away, which is also what makes, I forget to say this, market cap weighting so inefficient. So the US, if you buy a global market cap stock index, you're putting half in one of the most expensive stock markets in the world. Guess what? You did that in the 1980s too with Japan. You put most of your money in a stock market trading at a PE ratio of 100. So moving anywhere away from market, there's degrees of how weird you're willing to get. So first step is moving away from market cap weighting. Second step would be tilting towards even more value. It's just a matter of how much are you willing to do it. Yeah?
Yeah, just follow up on that. You're buying inexpensive stocks in countries where the market isn't overvalued. How do you feel about what's going to happen with that currency in 10 years? Where's the US dollar going?
So the question is about currencies and how to think about it. You finally found a question that, remember I said earlier that I don't have a strong opinion on. If you read Triumph of the Optimist and these other books, real currency returns over time, net of inflation, are fairly stable. In any given year, that doesn't mean they go up, down 20%, whatever. But over time, they're fairly stable and they adjust for inflation. So I don't care, and we did the results both ways, if you just buy these markets and don't hedge, or you decide to hedge. What you should resist is the opportunity to dance in and out, which is what most people like to do. So over time, it's going to be a wash. I have a different perspective on bonds. Because it largely introduces volatility that bonds don't have. But for the most part, I don't think equities matter. If you want to say, I want to go halvesies and hedge half of it, that's fine too. Any of those, I think, will work out over time. But the whole key is value. Yeah?
What are the countries you're referring to?
So if you go to this tweet on my Twitter, it has a bunch of resources where you can get these for free. There's like 5 websites that do it for free: Research Affiliates, Barclays, Star Capital. We send out a email newsletter called The Idea Farm. You can get a 30-day free trial. We publish it once a quarter. But if I'm off the top of my head, the 2 worst of the worst are Russia and Turkey. Greece is in there. It's a lot of emerging Europe, Czech Republic. And usually, by the way that countries get to single-digit PE ratios is because it's the P, not the E. It's because they went down 40, 60, 80%. I love the old investing maxim that investing is the only business when things when things in the store go on sale, everyone runs out of the room. So it's a weird way to approach it, but it's buying the hated and unwanted, and when blood on the streets is usually a great place to be.
Great. Meb, thank you very much. We've reached the end of time. The good news is Meb's going to stick around for a bit.
Yeah.
I think you're going going to sign some books.
Oh, okay.
So thank you for that.
I thought you were going to say have some beers.
Well, we'll
I'll do
feed
that.
you beer as well.
All right.
So thank you very much for being here. Really enjoyed
Thanks.
the conversation. As a small token.
Oh, great. Thank you.
Thank you, guys.
Appreciate it. Awesome. Thank you.
We've also made
Thank
a
you.
donation at Sick Kids. In here.
Awesome.
So